Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for, and what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for joining us today. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Yes, we're independent. Yes, we are an investment advisory firm, and we're a fiduciary. Those are very, very important topics. But at the end of the day, our job is to make sure that you have strategies in place inside your portfolio that can handle the last few weeks of what is going on in the market. We have a lot to get to today. I want to wish everybody a happy Easter. It is a great weekend. Hopefully you get to spend some time with your family. If you have any investment-related questions and you like or want more clarification on a topic that I speak about on the radio show, please just give Paige or Jenny a call, and you can get on our team's calendar, 630-492-1912, 630-492-1912. The radio show is all about education. You understand that if you've been listening for any length of time, that we are here to educate. We are here to talk about strategies that can deliver positive returns to a point in a negative market. We're here to talk about strategies that can make sure that even if the markets are going down significantly, that your portfolio is protected. I see far too many advisors not do that to clients. And honestly, clients tend not to pay a whole lot of attention to volatility until it happens. And my job, if I can do anything, if you have any interest, is to have people reach out to firms like ours before the markets go down. So 630-492-1912. I see so many portfolios that just from the jump are not going to be able to handle what we're going through. And it's our job, I think, as fiduciaries to make sure that we get out there and we talk about it. We're going to continue to hit lazy advisors, dinosaur advisors very, very hard, simply because it's my belief that 99 out of 100 advisors are adding no value. And it really just comes down to the last couple of weeks. Look at your portfolio. And again, our equities are down, no doubt about it. I mean, that is just what it is. But what about the other strategies in your portfolio? What about the banknotes? What about the principal protection? What about the energy strategy that can greatly reduce your taxable income? It is amazing to me how many individuals reach out to us simply because of the banknote strategy. Everybody who hears about it, the next question that they're going to say or ask generally is, why doesn't everybody do this? And it's just lack of education. It's not a cutting-edge strategy. I guess it was a cutting-edge strategy in the early 2000s, but it certainly isn't a cutting-edge strategy today, especially when the minimums now are only $1,000 per banknote. But I want everybody to hear this. We just did a banknote backed by JP Morgan, and it paid 15.45% annually, as long as the S&P, the Russell 2000, and the KRE Regional Bank Index are not down 30%. So please hear me. 15.45, as long as those indexes are not down 30%. What if you had that in your portfolio? What if you had a strategy that you knew you were still going to get paid monthly interest payments backed by one of the largest banks in the world, most credit sound banks in the world, as long as those indexes were not down 30%? Maybe it's 10% of your portfolio, maybe it's 50% of your portfolio, maybe it's 80% of your portfolio. That obviously is totally individualized. But the point being here is a strategy that is so simple, so basic, yet so underused by the retail financial advisor. By retail, we're talking about advisors that will advise on generally $1 to $10 million of investable assets. Shocking to me, absolutely shocking. I think it's financial malpractice not to have those conversations with individual investors. Now, candidly, 15.45 is the best I have ever seen. So we're going back a long, long time. But with that volatility, it presented an opportunity that you just had to be a client of ours to take advantage of that. And so 15.45 was incredibly high. But I'm not going to complain, or I'm not going to justify away how we were able to get such a great rate, because this is a strategy that we do consistently. Generally, the strategies, the banknotes are going to be between 12 and 14%, depending upon volatility. But again, 15.45%. How nice would it be to have a bucket of your money in volatile times that you have a 30% buffer before you don't get an interest payment of 1.25%, a little over 1.25%. So if we're in a period of the market, which I think most people are going to, the advisors may not tell you this. They're always going to paint a rosy picture. They're going to tell you that don't worry about it. You're going to be perfectly fine. Sit and wait. Markets come back. All the typical nonsense. And I guess it's not nonsense. For equities, that is very, very true. I mean, the markets ultimately always go up over time. Now, time can be different. It can be 1 year, it could be 5 years, it could be 10 years. And so that could derail some plans out there. That could create some sleepless nights. But how nice would it be to have a bucket of your money that you knew you had a predefined strategy, that you had a 30% buffer to still make 1.25%, a little more than 1.25%, backed by one of the largest institutions. In this note happened to be JP Morgan. So our clients know that. Our clients know when we do these dinners throughout the Chicagoland area and we talk about the most important questions to ask financial advisors, I always share with individuals who come to these dinners that 95% of what I say, what other radio shows say, what other advisors say are going to be very, very similar. And it's going to sound like advisor speak. It's going to sound, just very, very similar to the next person. But it's the 5% that is different, that is truly unique in the banknotes and the energy strategy, that are going to make the greatest differentiation of how well you sleep at night. So many individuals, if you're in that what they call the retirement red zone, some people say it's 5 years pre or post retirement. Some say 7 years. Some say 10 years pre or post retirement. The reality is that if a retirement is on the horizon or you're in retirement, losses are magnified. You don't have the money, generally speaking, to take advantage of the big swings in the market. And so that is why it is so, so critical to make sure that you can point to something in your portfolio that has a predefined outcome. And so we use, as I mentioned, the banknote strategy. Again, 15.45 was the last one that we did with 30% downside. And then we use the principal protection strategy that currently you get the first 10% of the S&P 500 on an annual basis. If the S&P is negative, your return is zero. So our clients know what they have in their portfolio that is their safe money, their protected growth. And that was where I was going. So when I talk when I talk at the dinners and speak at the dinners, the most important question I think you can ask an advisor has nothing to do with fees. Unfortunately, everybody is conditioned to be that's your very first question. It's the very last question. I don't even think about it when I look at a investment strategy. Personally, mentally, fees never come into question. I may check that box towards the end, but candidly, I look at after fee returns, and that's all that matters to me. But the most important question you can ask yourself, or you can ask the advisor that you're working with on Monday, is very simply, what do we have in our portfolio that will protect principal and that will still deliver positive returns in negative markets to a point? Unfortunately, most advisors, they can't tell you, and they can't answer that question because you don't have it. Most advisors are still using bonds as a means of portfolio diversification. The question I have is, how is that done for you? You know the answer. I know the answer. If you don't know the answer, look at your statements. Most advisors are still using bonds as a means of portfolio diversification. Look at what the 10-year, pick your favorite 10-year bond fund, under 2%. I mean, under 2%, not even keeping up with inflation. way underperforming, and there are just better alternatives, i.e. the banknotes. So if your advisor cannot specifically point out that you have 20%, you have 18%, you have 19%, you have 30%, you have 50%, whatever that number is, in a strategy that is predefined just like the banknotes, meaning last note we did, 15.45%, as long as the S&P, the RTY, and the KRE were not down 30%. You got your monthly coupon. Just simply take the annual coupon at 15.45, divide that by 12. That was your interest rate. Coupon interest rate, I use them interchangeably. But anyways, if you don't have that, you must, in this market, you must reach out to firms like ours that utilize strategies like that. 630-492-1912. And then when it comes to tax planning, we're going to get to annuities today. So for all of my annuity fans out there, all the people that say, we're annuity haters, all the people that, I hear when we talk about or send me emails that you don't like annuities, you don't do this, you don't do that. I'm going to share with you a real live case, a real live example of why they are missold, why other advisors on the radio, especially on the radio, my goodness, on the radio, most people that you're going to listen to, except one radio show that I know of that runs on the weekends, that I know is not solely dedicated to doing annuities. Now, they may masquerade as somebody other than an annuity salesman, but we can tell immediately. And the reason we can tell is because if you reach out to us, there's a good chance that you're reaching out to other people that are on the radio. So we know what the offerings are. And it's my job to know that. And it's not my job to say anybody's doing bad, but my job is to say that those lifetime income annuities are not what you think they are. And I think the biggest problem with the industry is these illustrations. And we're going to go over that in the next segment. We're going to talk about an illustration. We're going to talk about how it showed 12.6, 12.7% a year guaranteed. Well, that wasn't guaranteed against loss. But those investments were able to show a 12.6% a year. And I started to think to myself, I'm like, no wonder so many people are buying these things, because these illustrations. And then we're going to talk about what the real performance was. So 630-492-1912, because there's a couple facts that we really have to look at here. And when I see tweets like, fact, a bear market is a bull's best friend, I think about that and I think, you know what? I agree with that. Personally, I 100% agree with that. I love volatility. Most advisors, they don't like, or most investors, they don't like volatility because their advisors have them positioned incorrectly. They don't have them positioned to take advantage of the volatility. And so much of active management has been tagged as day trading. My gosh, that could not be further from the truth. But you know what? You better play offense. You better play defense. Our aggressive growth strategy, which again, almost annualized 25% over the last 10 years versus the S&P at 13. Now, I need to see those numbers updated given, the last week, of course. And I have to caveat everything because we believe in radical transparency, that past performance is not indicative of future results. It's a third-party manager. Everything that we do is third party. I have a very strong opinion about fiduciaries that are doing in-house money management. Are you really a fiduciary? Can you really fire your manager? Generally speaking, if it's your firm, you're not going to forego that revenue. So I wonder how biased is a fiduciary if they are using money managers that are in-house. So we're going to talk an awful lot about that as well. But again, our aggressive growth strategy, that's a good portfolio. Protected growth, aggressive growth, tax, and alternative. And it may only be 3% of your money, maybe 7% of your money, maybe 10% of your money, who knows? But it's a mathematical trend-following strategy, and we're going to talk about that again this week about computers. And that strategy, as of, I haven't seen updated this week, but as of last week, that strategy was 50% cash. Again, not trying to time the market, doing the computers or letting the computers do what they're good at. So we have a lot to get to this week. 630-492-1912, 630-492-1912. Give Paige and Jenny a call, and let's have a conversation. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, President, founder of Kuhn Capital Partners, independent registered investment advisory. And yes, we are a fiduciary that utilizes and believes in third-party asset management. I don't know how you can be a fiduciary and have in-house asset management. I just don't know. And I'm still, it's not something that I have spent a whole lot of time talking about. But I definitely am going to start talking about that, especially given where we're at in the market, because it's an issue. I think the job of an advisor is to always create a portfolio that can deliver positive returns or protect principal, positive returns to a point, because at some point on the downside, especially with the banknotes that we utilize, you have 30% protection to still get whatever that interest rate that note is paying. Last note we did was a JP Morgan note, paid 15.45%, as long as the S&P, the Russell 2000, and the KRE Regional Bank Index were not down 30%. Think about that. That's on top of the volatility that we have already heard. And here's the problem with that. We talk about these banknotes all the time. Here's the deal. We price the note. We strike, which means we buy the note, commit to the note the next day. So if you have any interest in taking advantage of the banknotes or talking about the banknotes, you have to have that money at our firm, which is our firm's not Charles Schwab, but that is our custodian. So all of our clients we custody all of our clients' money at Charles Schwab, meaning that's where your accounts are. We're just simply the advisor on the accounts. Everybody's heard of Charles Schwab. It's very easy. Through our assistants, we open the accounts at Charles Schwab. We're simply the advisors on the account. At any point, you can call Charles Schwab and you can say, hey, remove them. And guess what? The next day, we are removed. So we make it very, very easy to work with us. And candidly, we make it very, very easy not to work with us. But if you have any interest in the banknotes, people are going to reach out this week because of the 15.45. That was the note that we got. That was an actual note from JP Morgan. We priced it on one of the most volatile days in the market in history. But here's the problem. Only clients or investors that had money with us were able to participate in that note. So it's just, you have to, if you want to do it, you got to do it. So 630-492-1912. And there's so much wrong with this industry. There are so many advisors that are lazy, so many advisors that are making seven figures that don't want to rock the boat. And the client in markets like this are the ones that are getting hit. And then the simple question of the answer from an advisor is sit and wait. My goodness, that is a fireable offense. And so we're really going to pick up the marketing. We're really going to pick up the message on the radio. Because, listen, if you don't like the fact that I share strategies on the radio, if you don't like the fact that I call out the industry, then don't work with us. Then don't think about us. Don't listen to the show. I mean, it's not, like we say, it's not a God-given right that, we work with everybody. Working with an advisor is not a lifelong contract. You don't know what you don't know until you see markets like we've seen the last 3 weeks. And then people start to say, well, maybe I need to start interviewing somebody else. Maybe I don't have what I thought I had. Maybe it was the stimulus that drove everything up. Maybe my 12-year-old was just as good as a stock picker that has 50 years of experience and is a mathematician, because generally in a bull market, everything goes up. Well, that, a lot of people are starting to realize that. And so when we look at portfolios, we see the deficiencies way before you do. And it's our job to make sure that you know what you don't know. Because, listen, if the markets continue to stay down or flat, which could easily be done, here's what nobody wants to talk about. We could see a flat to sideways market for 3, 5, 7 years. That's reality. And not saying that that's going to happen, but this is a global reset in the way companies look at business, and it has nothing to do with politics. It just is. And that doesn't mean that the markets are going to crash. That doesn't mean that the markets are going to go vertical. But the consensus is, with uncertainty, with the ability for businesses not to plan with what is going on with tariffs, whether you like them, whether you don't like them, whether you think they need to happen, whether you agree or you don't agree with implementation, the reality is none of it matters because it's going to happen. You have no control over it. I have no control over it. It's a tweet here, a tweet there. The weekend we're excluding, iPhones and chips and some of the tech sector. The next day, well, that really wasn't the case. That's the world we live in, and it has nothing to do with politics. We have to look at where we live, where the market is, and what we're going to experience over the next 1 to 3 to 5 to 7 years. And even before this disruption that the market has experienced, even before that, you had global investment banks, and you can listen to the radio show 3, 4, 5, 6 weeks ago that were saying that we're in a low growth environment. We're in a 2% under annualized over 10 years. Some will say 3, some will say 4. The bottom line is the markets are going to have a hard time making money. What does that mean for you? That means if you have buy and hold, if you have an asset allocated strategy that is masqueraded as, something very, very proprietary, you're going to have underperformance. And if you're not taking advantage of an investment that can still deliver double-digit returns, generally, like the banknotes, double-digit, generally it's always going to be north of 10%. Yes, we got the 15.4. Don't know if we'll see that one again. Maybe we will, but generally it's going to always be over 10%, generally between 11 and 13 with 30% downside. You just compare that to what you're doing. If you don't have that in your portfolio, I'm afraid that you're going to be very, very disappointed with your portfolio performance over the next 3 to 5 to 7 years. And that's just my belief. So 630-492-1912, 630-492-1912. Because, look at, JP Morgan last week. They said the S&P 500 could plunge another 26% to 4,000 in a worst case scenario. Again, worst case, it may be 1 out of 10, it may be 1 out of 20, maybe the odds are 3 to 5%, maybe they're 7%, who knows? But one thing that I know in the market, one thing that I know is that the anomalies are happening more than we give it credit for. Just look at since 2000, just think since 2000, what we have been through. And today, when you look at the S&P, the top 10 S&P stocks now account for almost 37.7% of the S&P. That is the highest concentration in more than 60 years. That's probably fine, right? I don't know. I mean, that's what's very, very concerning. And, it's a challenge. And I sit here on a Saturday because the show runs on a Saturday and a Sunday, on multiple stations here in the Chicago market. But you're driving around, you're catching the show, maybe via podcast. And as humans, we are conditioned to always be optimistic, at least most of us. There are some that are not that way, but most of us are conditioned to be optimistic. And so you're conditioned to think the best. You're conditioned to think, well, I'll just sit and wait. Well, I don't know if that's going to make it. I don't know if that's going to be the best strategy. If you don't have strategies in your portfolio, 30, 50, 70, 20, 18, I have no idea what the percentage is that can still deliver positive returns in negative markets. I think you are very, very, very ill-advised, and that's what we're doing. And then, we also look at, so we do a lot of financial planning, and as advisors, I think, you've got two sets of groups out there, two types of firms, ones that are very, very good at planning, ones that are not good at planning, but very, very good at investment management. We want to be both. I think our planning, I think what we look at on lifetime taxes and what you're going to have to pay, once RMDs start to affect your portfolio, or if you're already taking RMDs, you already know that, for some strategies that we can look at to shelter the tax from those RMDs. That's the job of an advisor. We're not here to tell you what to do. We're here to lay out the data. And when we look at the financial planning, when we look at just how ill-advised many individuals are, and they're setting themselves up for really a tax bomb, when they have to start taking RMDs, really, these are things you don't plan. It's like, taxes. We have an energy strategy. Our energy strategy can reduce your taxable income, taxable, active or passive, by 70 to 90%. So you invest $100,000, the fund can reduce your taxable income generally from $70,000 to $90,000, active or passive. How's that for tax strategies? When most advisors are simply bringing tax loss harvesting. I mean, good gosh, it is a tax strategy, but that is not proactive in any way. If you're with a big bank, if you're with a big brokerage firm, you have very little to no tax planning, ways to reduce your taxable income. So think about that. So you sold a business, you're a high wage earner, you're a physician, attorney, whatever, making $500,000, $1 million, $2 million, $3 million, $5 million a year, whatever that number is. You're in a high tax bracket. You want to do Roth conversions. You're in a high tax bracket. That prevents so many people from doing Roth conversions. What if you had an energy strategy that was a direct energy investment, meaning you invested directly alongside of the Exxon, Chevrons, Conocos, et cetera, of the world in their projects, and you got significant tax benefits, and it was not correlated to the S&P. So the distributions from that investment, there's no correlation. Well, there is a correlation because everything I think is somewhat correlated to the S&P, but the distributions aren't dependent upon a positive market. So just in 20 minutes today, I've talked about the bank notes. 15.4 was the last bank note by JP Morgan. You got that as long as the indexes weren't down 30%. I talked about the principal protection strategy. Everybody, looks and I don't know if they laugh at the principal protection strategy, but in this market, they're starting to love it. But a strategy that is tied to the S&P 500, and you get currently the first 10% a year of the S&P. Anything on the negative side, so if the S&P is down at all, your return is zero. There are so many people in the Chicago market, really throughout the United States, that you would say, okay, for some of my money, if I can invest it and have the growth tied to the S&P on an annual basis, if the S&P is down 0.1 or 100%, my return is zero. And I get the first 10% of the S&P on the upside. Now, it does not include dividends, so it does not include dividends. You have to know that. But I could get the first 10% of the upside of the S&P 500. And once I get a gain, that gain is locked in for the life of the investment. That's a pretty darn good strategy. Well, that is a pretty darn good strategy for some safe money. And then we talked about the energy strategy that can reduce your taxable income significantly. On average, generally $70,000 to $90,000 per $100,000 invested, and is going to target double-digit distributions, maybe low double digits, maybe high double digits. And you're investing directly inside of the majors, the Exxon, Chevrons, Conocos, EOGs, et cetera, of the world's project. I just gave you 3 strategies on a Saturday and Sunday morning that would do so much to I would believe it would do so much to the predictability, the volatility of your portfolio to, take away a lot of the unknowns of this market in 25 minutes. And those are very, very basic strategies. And that's my job. And that's my job. And that's why I talk about it on the radio. And I hear a lot of times, well, you talk about the same thing. Well, yeah, I do. But you know what? These are very, very important things. And they're things that you have to make sure that if the markets are down, if they are sideways, because here's what you say to your client, your advisor. Advisor's going to say, don't worry about it. Markets come back. Okay. What happens if you bought Microsoft in 2000 and it took you 14 years to get back to even? 14 years to get back to even. What if? It may only be a 1% chance, maybe 5%, maybe 10%, heck, maybe 50%. I have no idea. But how are you, Mr. or Mrs. Advisor, going to manage that? How are you, Mr. or Mrs. Advisor, going to still deliver returns in that market? Show me. This is not I'm done with listening to what anybody says. I imposed that rule long ago. It's now a show me business. So 630-492-1912. We're going to talk about annuity illustrations after the break. Welcome back. You're listening to Destination Retirement. Happy Saturday or Sunday, depending upon when you're catching the show. Happy Easter. Hopefully everybody is having some downtime with family. Very, very important. We know that. I know that. Everybody knows that. And hopefully you're taking some time off. But my job is to think about your money. My job is to talk about strategies that can handle the craziness in the market. My job is to talk about strategies that can deliver positive returns even if the markets are down to a point. My job is to talk about tax reduction. My job is to talk about strategies that can greatly reduce your taxable income. Our energy fund can reduce your taxable income on average by $70,000 to $90,000 per $100,000 invested, investing directly alongside of the majors and their projects, the Exxon, Chevrons, Conocos of the world. In the single best oil field in the world in the Permian Basin in West Texas. Those are strategies that we are bringing to our clients. So if you have any questions, if you want to learn about the banknotes, last banknote was JP Morgan, 15.4%, as long as the S&P, the Russell, and the KRE, the regional bank index, were not down 30%. You got that monthly interest payment, which is 1.26, 1.27% a month. So very, very reassuring for clients to be able to have something that is still delivering positive returns, even if the market is down 30%. So 630-492-1912, 630-492-1912. If you have any questions, just get with Jenny or Paige. They'll certainly set up any time that works for you, time that works for us, an informational call, and we'll just kind of go from there. Those calls are very high level, very simple, and we just talk a little bit more about what you're doing, what you like, what you don't like, where you're at, what do you think you don't have. We talk about your financial plan. We talk about your income plan. I mean, we're meeting with people that are retiring in 2 years, and they don't have an income plan. 2 years, and they don't have an income plan. They haven't talked about RMDs. They haven't talked about Medicare, and kind of, Part B and D and supplemental and what the premiums are going to be. And when you look at our tax strategy and our tax software, now we're not CPAs. We cannot give tax advice. But the tax software that we use for our clients the look through that you get when you send us your tax returns is absolutely second to none. And that, again, not only does our offerings of the banknotes, of the principal protection, of the tax advantage, tax reduction strategy, that puts us on an island of very few advisors. When you look at the planning software, when you look at the stress testing software that we use, when you look at our tax software that we use, we really become one of very few. And that is why when people tell us that we're looking at other advisors, I'm like, meet with as many as you can, because you're going to see really, really quickly when you hear that we talk about downside, we talk about, strategies that can still deliver positive returns in negative markets. When we talk about principal protection from some of your money, when we talk about some aggressive growth strategies, albeit it may be a very, small portion of your portfolio, but you should still have it. And we talk about how everything is mathematical, is quantitative, is repeatable. And then you add and layer on top of that tax reduction and the financial plan and the tax planning software that we utilize. If you're already taking RMDs, you know what the tax hit is going to be. Call us. You have to call us if you want to talk about strategies that can reduce the taxable income and the tax you're going to pay if you are already taking RMDs. Again, people who are already taking RMDs think they have, no recourse. They think that, well, I just got to pay the taxable income. If you have a seven-figure or more IRA, you know what those RMDs are. Massive. And in a lot of instances, especially here in Chicago, because there's just so many savers, in many instances, if you have a large IRA, you're taking more out in RMDs, or you're going to have to take more out in 3 years, 5 years, 7 years, 10 years, whenever those RMDs are hit for you. You may be taking more out in RMDs than what you made on an annual basis. So think about the taxes. Think about what that's going to do. We've seen tax bills for seven-figure IRAs in your 80s of our RMDs of $300,000, $400,000. Think about the taxes. And if you don't have any planning, if you don't have any strategies to reduce that tax bite, you're just, unfortunately, you're not with a cutting edge, proactive, financial advisor. And again, I hate now our tax strategy is very forward thinking. Now it's very private equity based. The challenge is, with our strategy, if you were going to, at least it's our belief that, private equity does it. We know that for a fact, but generally you have to give them a $5 to $10 million check to get access to those strategies. Well, we have this, what we believe to be as good of or better risk management, as good of or better deals in the energy space, investing directly alongside of the majors, the Exxon, Chevrons, Conocos of the world. That is our belief. And you only have to invest $100,000. So think about that. Now, you have to have a net worth of $1 million, not including your primary residence. So you have to have a net worth of $1 million or make $200,000 single or $300,000 of joint annual income over the last couple of years with a high level of predictability, which I don't even know how they measure that's going to continue. So there are some requirements, not my requirements, but just look at accredited investor. And if you hit that criteria and you're taking out RMDs, you want to do Roth conversions, and you want to, or you're a high wage earner, or you sold a business or a building, or you have significant embedded capital gains, and you have concentrated stock, and you want to, learn about how to mitigate those taxes, we need to have a conversation. We are one of one advisor that is going to bring you that type of a strategy. That I am very, very confident of. So 630-492-1912, 630-492-1912. Because when we see headlines like the S&P has now erased all gains since March of 2022, just like the last 3 years didn't happen, that's an issue. That is an issue. And I am finding finally, investors are waking up to the lack of proactive management, proactive strategies that advisors are bringing to them. I am so thankful of that. And I don't know if I'm going to take any credit for that, but if you listen to this radio show and you realize that there are strategies that are what we call predefined, where we know the outcomes prior to when you invest, this isn't rocket science. This is not rocket science. I mean, these investments are not new. These investments are not, short of the energy strategy, cutting edge. They just now don't have a very high net minimum investment requirements. And over the years, those requirements, have gone away. And now the requirement for the banknote is literally $1,000. $1,000. In my opinion, it's my belief, there's a lot of people listening to this radio show that would have loved to have a banknote. And again, there's a legal name for it, Phoenix Auto Callable, blah, 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 blah. But it is a prospectus item. So you do get a prospectus. We just call them an income banknote because they pay income and they're backed by the bank. But we did the JP Morgan banknote last week, 15.45%, as long as the KRE, S&P, RTY, which is the Russell 2000, are not down 30%. That's another 30% from the date that note was priced. Think about that. How many people would love to have 5%, 10%, 15%, 30%, whatever that number is, in a strategy that was going to pay you over 1.25% a month with 30% downside protection? So now, candidly, that was a very, very high note. We normally don't see 15.4. That was shocking to me. But again, the volatility created that opportunity. But you have to be a client of ours to take advantage of those. So 630-492-1912, 630-492-1912. We do price notes generally on multiple times a week. So again, I don't care if it's part of your portfolio, if you want us to manage all of your money, if you just want us to manage, your predictable money. To me, it doesn't matter. It really, really doesn't matter. I mean, we are not going to do it for $1,000. We're not going to do it for $10,000. But if you have a couple $1 million and you want to farm out, half or a quarter to strategies that are predefined, and we're okay with that. I mean, I don't know what the exact percentages is. Generally, we manage the bulk of, our clients' money, all of it. But, again, we certainly have 5%, 10%, whatever that number is, that we just are a satellite manager, and we're okay with that. Because I think once you see the innovativeness of what we're doing, which, again, I say that, but these are, like the banknote strategies. I mean, these are a $200 billion a year, $200 billion plus a year space. Just because it's new to you doesn't mean it's not a massive, massive space. It's just generally been higher net worth. It's generally been more family office, more private wealth management type strategies. But again, we're changing that. And I love it. I love it, love it, love it, because we have investors that are taking more in income than they really should be simply because of the banknotes. There's a lot of investors out there that have, $500,000, million, 2 million, whatever that number is, and they need significant income. And if you're doing the old school of thumb where, 4%, which I can't even believe people still talk about that, but the 4% rule, which is so many flaws to that. I mean, you're giving up so much. If you got your protected money in the bond market and you're getting a 10-year number, pick your favorite, aggregate bond index. I don't care what it is, Vanguard, Fidelity, Schwab, it doesn't matter. Pick your favorite one. Look at the 10-year performance. I'm going to guess that it's under 2% annualized. 2%, not even keeping up with inflation. Oh, it's these asset allocated models, and it's the target date models. And how have those done for you the last 5 years? How have those done for you? I had a client who retired from, a food supermarket here in Chicago. Thought he was doing the right thing. Thought he was doing the absolute right thing. He knows who he is if he's listening to the show. Thought he was doing the right thing by having money in the target date funds, because the closer you get to retirement, the more you have to have in fixed income. Guess what? Generally speaking, that's the right strategy. Absolutely, positively. However, not in this interest rate environment. Not in this interest rate environment. And so these sell and may go away, take your age, minus 100, that's how much you have in fixed income. Generally, those are going to work. But you know what? They don't work all the time. And if you can't realize that, then you may be the one that is stuck. So we want to fix that. We love doing the dinners. We love doing the radio show. We love just the education. We have so many clients that come from Central Illinois. We love that as well. WLS and the other stations that we're on, they obviously have good reach. Here in Chicago, we have people reaching out to us often, not daily, but often, about taking the radio show and syndicating it nationally. I don't know if I'm there yet. That's just a whole lot of work. But that's certainly something that people have reached out to us and maybe something we'll consider, because we really are trying to just educate. We're trying to educate. We're trying to give you 25 years worth of experience in an hour radio show. And the beautiful thing about the radio and the beautiful thing about the dinners, well, certainly the radio, is that we allow you to listen to all of our past shows. So we've been on the radio here in Chicago, I think, for 3 or 4 years, maybe 4.5 years now. You can listen to all of the past radio shows. And so you can get a feel for what we were saying when interest rates, when the Fed was blatantly telling us that you better make sure that you're positioned correctly in the fixed income market, because rates are going up. When rates go up, bond prices go down. And if it was the only option, then you just have to sit and take it. I'm sitting there listening and driving. I don't listen to CNBC all that much anymore, but I was in the car heading to a meeting and listening to a fixed income manager come on and talk about how, you have to stay mid-duration, 3 to 5 years, 3 to 7 years, low credit, go higher on the credit, and credit quality with the, with the companies, et cetera, et cetera, et cetera. And I'm thinking, and then they say a rate and they're touting, 3.5% to 4%. And I'm like, oh my goodness, 3.5% to 4%. And you can go out and get a banknote that's backed by the largest bank that we know the strategies, the rules going in, that are giving you double and triple that. So again, in this game of investment advice, it just comes down to education. So 630-492-1912, 630-492-1912. And yes, I'm going to talk about annuities and illustrations after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. A lot of good things happening with us. A lot of good growth initiatives that ultimately are going to benefit our clients. Many of you know, if we've talked, if you're a current client, that we want to create a tax arm so we can do, if you so choose, I can't do them, but we can hire, we're looking at, and if you're a CPA out there, if you are a solo CPA and you want to grow, if you're a small firm and you want to partner, reach out to me, because that's an offering that we want to bring to our clients. 630-492-1912. So 630-492-1912. Because as you know, the most overlooked area, in my opinion, my belief, of financial planning, of investment management, is tax strategies. We're not talking tax loss harvesting. I can't believe that advisors hold that as proactive tax management. I mean, by the letter of the law, it is. It is exactly that. So maybe I'm the one that's wrong. But that should just be automatic in today's day and age. We're talking about strategies that can reduce your taxable income on average, generally speaking, by $70,000 to $90,000 per $100,000 invested. If you're taking RMDs, think about how we could take that, put it in the energy strategy, and mitigate those taxes due. Think about, if you're a high wage earner, think about how we could reduce that taxable income. If you have a building, if you sold a business, you're looking at a liquidity event. If you want to do Roth conversions while mitigating tax, we need to have a conversation. So 630-492-1912, 630-492-1912. And obviously the banknotes, 3 out of 4 calls from the radio are simply because of the banknotes. And then they learn about everything else that we're doing. They learn about the financial planning. They learn about the tax software that we use. They learn about the stress testing that we do. And we kind of see that $1 to $10 million investor who just has more of the same, really $500,000 to $10 million investor that thinks that they have something so unique, so proprietary because the firm is so big, so this, so that. And they realize that they have a portfolio that simply tracks the market up and tracks the market down. And those are the clients that call us. Those are the clients that reach out to us because they want more. They want more, and they realize that they need more. I think one thing that is I feel very confident in saying that volatility is here. Volatility is here to stay. A lot of it is just because of the computers and because of the trading and because of AI. Pattern recognition. I mean, think about that. There are softwares that are listening to every political person that are trying to get pattern recognition and then how to capitalize on that. That's the world we're in. You can either take advantage of it, invest alongside of it, or get left behind. I mean, those are really your options. One of the great things about technology is the investments. The investment options are new. Just because they're not mass marketed to that $500,000 to $5 million client. I mean, that's it. That is why. So let's talk about annuities. Let's talk about lifetime income. Would you believe I've seen people show people that you can invest some money, you're going to triple that investment with absolutely no risk to principal, and you're going to get 5 to 10% distributions a year. Think about that. But we had somebody that is interviewing, us and a few other firms, and they had enough respect for us to say, "Hey, we're being shown this annuity. Can you take a look at it?" And we love it. We absolutely love it. So if an advisor is selling you an annuity based upon an illustration, immediately your guard needs to go up. Immediately, the advisor barely understands them. I promise you, you'll never fully understand those annuity illustrations. And I have a very, very hard time with illustrations because the industry, when you look at lifetime income, they are allowed to illustrate strategies that did not exist. It's called back testing. So we had an investor reach out to us, show us this annuity, and this annuity showed 12% 12% annual growth. I think it was actually 12.4% annual growth with a 30% bonus. So you put in 100,000, they just magically give you $30,000. Now, that's for income purposes, but a huge bonus. And then you have an investment that has hypothetically averaged 12.3, I think it was 47% a year with absolutely no downside. I'm thinking to myself, no wonder so many people are buying this stuff. I mean, who wouldn't want that? My goodness. I mean, if that was real and if that was actually what happened, you don't need me. You don't need anybody. You can go get an investment that's going to give you 30% of your income, absolutely no potential for loss on an annual basis, and have investments that have done 12.47% a year. No wonder so many people are buying this stuff because it just shows really well on paper. Here's the problem. The problem is that'll never happen. The problem is in the real world, it didn't happen. So what we showed this client is we showed them on the illustration. We did it a screen share. They sent us the illustration. We walked them through it. I could sell the darn thing if I wanted to. So it's not like me saying, nah, we're going to shoot holes in it because we don't have access to it. We have access to it. And I showed him, I forget what page it was on, 3 or 4 or 5, but the 5 strategies that they shown, 3 of them only had 2 years worth of track record. The others had 5 years worth of track record, and then one had 10 years worth of track record. But yet the illustration software is showing as if they've all been around for 10 years. Well, let's look at the real returns. So we have this little nifty report from Annuity Rate Watch that we pay for. Well, actually, it's complimentary. We just work with a company that provides it for us. Totally independent. I think there's 150 different investment options. So every single index annuity out there, it shows the real returns, the real returns. And the real returns on that strategy that the illustration software showed 12.47, 3 of them had negative returns since inception. Now, it's not including the back-tested performance because back-tested is just computer simulated. That means absolutely nothing. You're never going to see, it's a funny joke, at least in our office. Who's going to come in here and show you an investment that back-tested negatively? Nobody is. Everyone looks perfect, every single one. But in the real world, it never, very rarely will it ever react or do what it shows based upon the computer, or else it'd be so easy to manage money. So they had 3 investments that had negative performance since actual inception. The one that has the 10-year performance, it returned 1% a year. 1%. So I'm starting to think, okay, you're looking at an illustration from a very, very large insurance company that shows a very, very big bonus of 30% and then shows growth at 12% a year. No wonder people are buying this stuff. And here's shame on the advisor. Shame on the advisor for not showing that client the actual real returns, not the back-tested numbers. Because all that advisor is doing is, and if you're doing it, you better learn because your clients are coming to us and guys like us and firms like ours. What you're setting yourself up for is a client to think they're getting the best thing in the world, and they're getting arguably one of the worst things that they could have invested in. It's a problem. It's a problem with the industry. We will never, or very rarely, will we ever sell an annuity that we can't explain in 2 seconds. Like that 5-year principal protection strategy. Anybody can understand that. That is an annuity. So for those naysayers out there that say, oh, they just don't like annuities, could not be further from the truth. We just want clients to know, you think you're getting an investment that's going to show you 12% a year, lifetime income this, lifetime income that, because if it grows higher and you have returns that drive the value higher, you're going to get higher guaranteed income. But I just showed somebody how no, they show 12%, that's all back tested. In the real world, not even 2. So you're just setting clients up for, to be unhappy. You're just setting clients up to reach out to people like us that we could walk you through it and then let you make an educated decision on what works best for you. So if you're being sold an annuity, if you're being sold lifetime income and it's being sold on an illustration and it looks, here's the reality. Those sub-accounts, which is, those indexes, the bulk of them are so new. I don't know this to be an exact statistic, but I'm going to just go based upon me remembering. 80% of those indexes have done under 2% a year. 80%. May even be 90%. Other than a gold, there's one in there that is a gold index. Now, good luck trying to find an annuity company that uses that, but that did 10% annualized, and that's obviously very, very good. There was only a handful that even did 5. A handful that even did 5. So if you're being sold an index annuity that has lifetime income, let's just see what the real performance is. Really simple. Email me the illustration. We'll hop on a screen share, and I'll walk you through it. I'll take it and show you what you need to look at. I'll show you the real performance. Again, the real performance, not what they're illustrating, because they can legally illustrate back-tested numbers. That bothers me. But again, it is what it is. So, the annuity strategy that we use, the index annuity strategy that we use, we don't use it for income. We think there are so many better ways to get income. What's the word? The biggest complaint about Social Security is, or any pension really, is lack of adjustment for real inflation. Good luck with that. Now, this annuity showed rising income. That was a crazy thing. Oh man, I could go down. We can talk forever on those illustrations. But anyways, the annuity that we use is a 5-year annuity. We call it just a simple growth annuity, no income component. And you get, currently, it's the first 10% of the S&P price movement. It doesn't include dividends. So you get the first 10% of the price movement, excluding dividends of the S&P. And you, on an annual basis, and anything, if the S&P is negative, your return's 0. 5 years, very simple, very clean. You can own it forever, but it's a 5-year commitment. And there's a ton of people that would love that, especially in this market for some safe money. So hopefully this show, I was a little more, had a little more energy, I guess, to say, just because I'm so tired of individuals just sitting and taking it. I'm so tired of investment advisors investing their money differently than they're advising clients to invest. So if you want to talk about tax reduction, if you want to talk about limiting RMD taxes, and talk about Roth conversions and how you can do that while limiting the tax bite, if you want to talk about the bank notes, that the last one we did, 15.45, again, very, very high. Don't expect that again, but it was there. It was a JP Morgan bank note, as long as the indexes aren't down 30%. If you want to talk about stress testing, if you want to talk about anything related to investment management, we'd love to have a conversation with you. Give Paige or Jenny a call, 630-492-1912, 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.